All right, let's just dive right into this incredibly dense 46-page earnings presentation and unpack the massive FY26 results from Avalon Technologies. Now, if you follow the electronics manufacturing services sector, EMS for short, you already know exactly how cutthroat and complex this landscape can be. But every now and then, a company drops an earnings report that honestly completely resets the baseline for what operational excellence looks like in this industry. So in this explainer, we're pulling the exact data straight from their deck to show you exactly how they're literally manufacturing their own success.
But before we get into the weeds, I've got to hit you with this one staggering number right out of the gate. A 78% growth in profit after tax. Think about that for a second. In a heavy industry where margins are famously fought for tooth and nail, a nearly 80% jump in bottom-line profit year over year is, well, it's nothing short of remarkable. It's absolutely the kind of metric that forces you to stop scrolling and ask, wait, how exactly are they pulling that off?
To figure that out, we're going to quickly cover 4 key areas today. First, the FY26 revenue surge. Second, unpacking their profitability metrics. Third, their global manufacturing footprint. And finally, decades of EMS evolution. Let's get right into it.
Starting with Section 1, the FY26 revenue surge.
So their top-line revenue hit a massive 1,603 crore rupees this year. That is a seriously substantial footprint of the market. Look, when you're dealing with numbers north of 1,500 crores in the EMS space, you're no longer just a participant, right? You're a major driver of the supply chain. You're moving massive volumes of raw materials, coordinating insanely complex global logistics, and delivering at a scale that very few can actually match.
And that revenue? It isn't just large, it's accelerating. We're looking at a 46% year-over-year growth, jumping from 1,098 crores in FY25 all the way up to 1,603 crores is a huge leap. What this tells us is that their sales engine is just firing on all cylinders and they're aggressively capturing market share. They aren't just coasting on industry tailwinds, they are actively outstripping them.
But the real star of the show is the bottom line, with that incredible 78% jump in profit after tax compared to FY25. Let's really think about this. Their revenue grew by 46%, but their profit shot up by 78%. So what does that actually mean? It means they have exceptional operating leverage. They aren't just selling more stuff, they're making significantly more money on every single thing they sell. The cost to produce those goods simply isn't rising anywhere near as fast as the revenue they're bringing in.
And if we look specifically at Q4, we see their 7th consecutive quarter of sequential performance improvement. They went from 24 crore in Q4 of last year to 33 crore in Q3 of this year, and then finished incredibly strong with 41 crore in Q4 of FY26. You know as well as I do, consistency is incredibly hard to achieve in manufacturing. So pulling off 7 straight quarters of getting better and better, that proves this isn't just a one-off lucky year. This is a systemic, structural improvement in how the whole company operates.
Moving to Section 2, unpacking the profitability metrics.
Looking at their efficiency, their CapEx-light model is boasting a 79% asset turn, and they've actually tightened their net working capital from 124 days down to 112 days. Let's break that down for a second. A 79% asset turn means they're generating incredibly strong revenue without having to sink endless piles of cash into heavy machinery and property. And by shaving 12 whole days off their net working capital, they're freeing up cash way faster. They get paid quicker, they manage their inventory better, and all of that fuels this really impressive 20.6% return on capital employed. They're quite literally squeezing every drop of value out of their capital.
Now, to quickly bust some industry jargon here, 54% of their order book is what's called box build revenue. This essentially means they're capturing much higher value by assembling complete systems instead of just basic parts. Think about it. If you just print a circuit board, you're basically a commodity. But if you take that circuit board, pop it into a casing, integrate the software, test the whole thing, and package it so it's ready to go straight to the end user, that's a box build. It commands way higher margins, it makes the customer much more reliant on you, and for Avalon, it makes up more than half of their massive order pipeline.
Let's look at Section 3, the global manufacturing footprint.
They are truly firing on both cylinders here, with the Indian market growing at 29%, while their US market customers delivered a massive 59% growth. This dual growth is absolutely fantastic to see. They're capturing the booming domestic demand right here in India, but they're also deeply embedded in the highly lucrative, extremely demanding United States market. Growing 59% in the US is a massive indicator that they are winning the trust of some major global players.
And even though 62% of their actual manufacturing is done in India, this dual footprint allows them to seamlessly serve massive global demand.
It's like they get the absolute best of both worlds. They leverage the cost efficiencies, the skilled labor, and the sheer scale of manufacturing in India, but they still have the proximity and relationship-building presence where their largest growth is actually happening. It's a highly optimized global delivery network that perfectly aligns with the current macro trend of supply chain diversification.
Finally, Section 4. Decades of EMS Evolution.
It's crucial to remember this isn't an overnight success story. Since 1999, they've strategically added capabilities like design and expanded into high-precision, long lifecycle industries like aerospace and railways. This is the literal definition of moving up the value chain. By entering highly regulated industries like aerospace and rail, they've basically forced themselves to adopt the strictest quality standards in the world. And once you're certified and fully integrated into an aerospace supply chain, your customer is highly unlikely to ditch you for a slightly cheaper competitor. That deep history creates a massive, almost impenetrable barrier to entry for any new competitors.
Which brings us to a really crucial point. Unlike peers such as Dixon or Amber, Avalon is the only Indian EMS company with actual manufacturing facilities in the U.S. This builds such a distinct advantage. When U.S. clients want nearshoring or local compliance, combined with offshore pricing leverage, Avalon can step in and offer a hybrid model that literally no other Indian competitor on this list can provide. It's a completely unique selling proposition, and honestly, it acts as an incredible magnet for North American contracts.
So considering their massive future order book sits at 2,196 crore rupees, which is up 25% year over year, by the way, the biggest question left is, what complex systems are they going to build next? They have the capital efficiency, the global footprint, and the deep engineering history to tackle almost anything. They have fundamentally transformed from a simple components manufacturer into a truly global, integrated partner. As they chew through this massive order book, are we looking at the early blueprint for the next major global EMS giant? I highly encourage you to look at how your own organizations might be utilizing these kinds of highly integrated global supply chains. Until next time, keep analyzing, keep learning, and keep asking the big questions.